Welcome to Uncovering Trusts, a podcast by the Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. Each episode will uncover the distinct features and latest developments of a selected listed investment company. So tune in to find interesting investment ideas and to stay on top of what's happening in the investment company sector. I'm your host, Will Manuel, and today I'm joined by Milosz Papst, Director of Investment Trust Content at the Edison Group, for a special episode to discuss the interim results of HgT, which invests in leading, profitable, unquoted European mid-market businesses with an international footprint, offering mission-critical, low-spend software solutions to SMEs. Milosz, thanks for joining us today.
Thanks. Glad to be back for the special episode.
And can you start by discussing some of the key highlights from HgT's recent results?
Sure. HgT continues to deliver strong NAV total returns with 6.4% posted in the first half of 2024, which brings its return over the last 12 months to end June 2024 to 13%. This is well ahead of other UK-listed private equity investment companies and allowed HgT to maintain its impressive long-term track record of delivering average NAV total returns in excess of 18% per year over the last 10 years. Importantly, despite the still quite modest exit activity across global private equity markets, which leaves many limited partners in PE funds starved of distributions, HgT received healthy gross realization proceeds from exits and refinancings in the first half of 2024 of close to £350 million, representing roughly 14% of HgT's opening NAV. A further 75 million of realizations is already signed and expected to close in the second half of this year.
Okay, interesting. So my question is, to what extent has HgT's NAV total return performance been driven by earnings growth across its portfolio compared to higher peer multiples used to value HgT's holdings?
Yeah, that's a very important question. The primary driver of HgT's performance was earnings growth across its portfolio, which has also been the major contributor to HgT's long-term performance. The company highlighted that the revenue and EBITDA growth across its top 20 holdings, which make up close to 80% of its portfolio, over the last 12 months was 19% and 26% respectively. I believe it is a strong level and consistent with what HgT's portfolio has delivered in the past. HG's head of research highlighted that the average organic EBITDA growth across HGT's portfolio holdings usually stands at around 10 to 15%, with the rest of the reported growth coming from bolt-on acquisitions, which, by the way, have also been supporting returns because they were carried out at valuation multiples below the multiple at which the acquirer was valued. I would also mention the healthy EBITDA margin of 34% over the last 12 months, which is again in line with what HgT's portfolio delivered historically. The company also highlighted that customer churn across its portfolio remains low and stable, supporting organic growth from cross and upsell. I would say that the consistent performance over the long term from a portfolio of relatively defensive but fast-growing software as a service businesses offering mission-critical, low-spend products is the main attraction of the trust. I discussed this in more detail in the latest review note published in August. Meanwhile, the change in multiples used to value the portfolio had a marginal negative impact on HgT's performance in H124. Historically, the long-term net effect from the positive and negative changes in multiples in the respective years have largely been neutral. In fact, HgT's investment manager normally assumes a multiples contraction in its investment case, although this has not materialized to a meaningful extent in the past. I would also note that the valuation multiples used to value HgT's portfolio holdings are normally derived from a blend of public and private M&A multiples and are less volatile than valuations in public markets. Therefore, if you look at the average last 12-month EV/EBITDA multiple across HgT's top 20 holdings since the beginning of 2020 and compare it with public software and services businesses, which is what HG has shown in their latest investment presentation, you will see that public multiples expanded more significantly in 2020 and 2021 than across HgT's portfolio, and then derated more strongly in 2022.
Okay, thank you. So that's reassuring that most of HgT's performance has come from earnings growth. But how do the valuations implied by HgT's recently completed realizations compare with the carrying values of which they're held in HgT's books before the transaction?
This is obviously an important consideration. What really matters in the end is if HGT is able to actually realize investments at or above the portfolio marks. The trust has a commendable long-term track record with this respect, with an average uplift of 35% over the last 10 years, which I discussed in more detail in our previous podcast episode on HGT back in March this year. The trust's full and partial realizations during the first half of 2024 were completed at an average 16% uplift to previous carrying value. This ability to consistently deliver solid realization volumes at or above carrying values may be one of the reasons that HGT trades close to net asset value.
Right. Okay. So you mentioned that HGT outperformed other listed PE companies. How about UK listed investment trusts investing in listed tech businesses?
Well, the outperformance of mega cap US tech stocks has been reflected in the NAV total returns of some of the UK listed tech investment trusts, most notably Polar Capital Technology Trust and Allianz Technology Trust, which over the last 12 months to end June 2024 visibly outperformed both HGT and several other UK listed investment companies investing primarily in public technology companies. Both of these trusts, as well as major tech ETFs, were also the top performers over 10 years, supported by the Magnificent Seven stocks. That said, HGT was the top performer among UK-listed tech-focused investment companies over the last 3 years to end June 2024. It also outperformed all peers except for the above-mentioned two over 5 and 10 years to end June 2024. In my opinion, this highlights HGT's role as high-quality technology play, which makes it a promising complement to listed big tech companies. By the way, the trust also significantly outperformed the MSCI World Small Cap Index and the UK All Share Index.
Okay, great. So now let's maybe turn to HGT's investment activity. I'd assume the solid realization proceeds would allow the trust to seize further investment opportunities.
Yes, I would start by highlighting that HGT has been quite cautious in terms of platform investments in 2023, but conducted more than 280 bolt-on investments across its portfolio in 2023 and Q1 24. HGT's platform investments year to date have increased significantly compared to the first half of 2023. That said, its manager highlighted that it remains sensitive to investment quality and valuation in a recovering market. Its £310 million investments in H124 include 3 reinvestments in Visma, Iris, and GGW, as well as complete new investments in Cube, active in automated regulatory intelligence and regulatory change management technology, CI&C Systems, a cloud-based software company serving the community association management sector in the US, and Endura, an independent corporate insurance broker in Belgium, which merged with its competitor Clover. It is worth noting that its investments in the first half of 2024 include £43 million of co-investments alongside an HG private fund, instead of the usual investment as a limited partner in the fund. These co-investments are free of fees and overall now represent 7% of HGT's portfolio, with the medium-term objective to increase further to around 10 to 15%. After reporting date, HGT made several further new investments, which it estimates will represent a volume of £183 million post-completion. These include, for instance, Audit Board, a connected risk platform for audit, risk, compliance, and ESG management, and Focus Group, a provider of essential business technology to SMEs, including IT, telecom, and connectivity services. HGT can redeploy most of its realization proceeds, as it is primarily a capital appreciation vehicle and therefore pays only a modest but regular dividend. Moreover, it often trades close to par and therefore is not tempted to embark on extensive buyback programs.
Okay, thank you. Is there anything of interest to update about the portfolio level debt in the first half of 2024?
Indeed, there is. HGT's portfolio manager has taken advantage of an improving funding environment to refinance a significant part of the portfolio level debt with estimated $140 million annualized interest rate savings. As a result, there are no debt maturities within the next 2 years, and over 80% of debt matures beyond 3 years across HGT's portfolio.
Okay, that's good to know. And how about the holding level liquidity and indebtedness?
HGT had £148 million of cash and cash equivalents at the end of August 2024 on a pro forma basis that is adjusted for all announced transactions, FX movements, and the declared dividend. Moreover, HGT has £310 million of an undrawn credit facility at its disposal, whose maturity was recently extended until March 2027. This credit facility and the cash and equivalents cover 65% of HGT's outstanding investment commitments of £707 million. I believe this is a safe level, given that these commitments are normally drawn over 2 to 4 years.
Okay, so thank you very much, Milosz. This has been a very interesting discussion. You've been listening to Uncovering Trusts, a podcast by the Edison Group. If you want to find out more about HGT and other investment companies we cover, please visit www.edisongroup.com.